Now, our first questions for today, August 12th, 2016. Donald's first question, does PowerOptions include options quotes and volatility info? Absolutely. Okay, so in any search, you see here the PowerOptions tools are designed by a tab navigation system, married puts, long collars, bear call credit. If you don't see a strategy that you want, Donald, simply click the Other Strategies tab, and we can customize this any way we want to. So the available strategies are over here on the left, bear call credit, bull put credit, calendar calls, simply buying calls, and so forth. So let me go ahead and clear everything out, and we'll just go ahead. Let me see something here. Hold on one second. I'm curious, before I get to Donald's question, let me just launch this quick poll. I promise you it's probably the only poll I'm going to ask during today's presentation. I'm just curious, what kind of option strategies are you all trading right now? Are you mainly looking at just call buying and put buying, or maybe straddles and strangles? Are you looking at covered calls and naked puts? Are you looking at insured positions, married puts and collars? Are you focusing on the vertical spreads, bear call credits, bull put credits, that includes the debit spreads and condors? Or are you doing sort of the time spreads, the calendar spreads, the horizontals and diagonals? Just a real quick poll. I'm going to leave this up for about a minute here. And we'll jump right into Donald's question. Sorry for the delay, Donald. I know you're waiting patiently, but we'll just jump into that answer. The answer is yes, but I'm going to show you where you can locate that information and how you can use that various information as well. I'm going to leave the poll open for another 5 or 10 seconds. It's been open for almost a minute. If you haven't voted yet, I encourage you to do so. So we'll just count down 5, 4, 3, 2, 1. Oh, some more votes coming in, so I'll let those roll in for a second here. Okay. All right, let me close the poll now, and I'll share the results with everyone. So 15% of you today are looking at call buying and straddles, and we do have 8% doing covered calls and naked puts. It's a little bit lower than I would expect. 31% of you are doing the insured positions and married puts and collars, and 38% of you, the winner today, are doing vertical spreads, bear calls, bull puts, perhaps iron condors, and 8% are doing the calendars. Okay, so I'm going to go ahead and hide that, and what I'm going to do right now very quickly, excuse me folks, let's go ahead and add in our credit and debit spread. So I'll add in the bear call credit and the bull put credit, and let's add a debit spread. We'll add bull call debits as well, and iron condors. Let's see, we also want to add in married puts for the 31% of you doing those types of strategies. So I'll add in married puts and collars, the long collar position. To our strategies, let's see, what else do we have here? 15% buying calls, that's important. So let's just do long calls here as well, and maybe straddles. You know what I'll do? I'm going to take off collars for the time being. We're going to add in long strangle. And then, of course, we had 8% of you doing covered calls as well. Let me take off, yeah, covered calls here as well. And then we did have 8% of you doing calendar spreads, and I'll add that back in just a moment also. Okay, well, that's just how to customize it. Now, to Donald's question specifically, in any search, so if I go to bear call credit spread right now, and I click on search, ignoring the results that are at the top of the screen, if I scroll down below the default parameters, right here we're looking at weekly bear call spreads, the second section in the option criteria will always be for implied volatility. So you could screen specifically if you had a limitation on the implied volatility of your sell option, or the implied volatility of your buy option in a spread, or the implied volatility ratio, the sell implied volatility divided by the buy implied volatility. What I might use there, of course, is to look for a ratio of greater than 1, hoping that my sell implied volatility is a little bit higher than the option that I'm buying in a spread, either the credit or the debit. In addition to that, in the technicals screen, you can also screen by the historical volatility of the stock. Okay? Any search criteria that you can use in the filter box in the parameter field, you can also see in your results. So if I click on choose columns on any search, this will take us to a configuration page, and here I can choose to see the short implied volatility in my data results, the implied volatility ratio, the long implied volatility, and the stock volatility as well, the historical volatility of the stock. Okay, now that's the basic view. Let me just close the window there so you can see that. So refresh the page. So now you see on the far right hand side we have the short implied volatility of our options, the long implied volatility, and the implied volatility ratio. Now, for single option strategies, whether you're looking at covered calls, one option, it's a spread because you're doing stock, you could look at it that way, but it's just a single option. But things for covered calls, married puts, buying calls, buying puts, cash secured naked puts, and so forth, additional filters that you might see in the search will be for the percent implied volatility range, as well as IV over HV. So the implied volatility ratio, the implied volatility of the option divided by the historical volatility of the stock. And anytime you have a question on a filter, you can just hover over the listing there for the filter itself, and you'll get a description. So since this is a long call, the default is looking for an IV over HV, implied volatility of the option divided by historical volatility of the stock, of less than 1.05, which means that we're only looking for options that may be as high as 5% overvalued, but they have to be undervalued with the implied volatility compared to the stock volatility. More importantly, there's also the percent implied volatility range. This shows you where the option's implied volatility is right now compared to where it has been over the life of the option. So this is a good thing to view. A couple questions that came in about this today, and I actually used this feature, and I'm going to show you how I used that the other day. It didn't work out as well as I wanted, but I actually lost less, and I'll explain that in a moment, looking at a potential strangle with a stock that had earnings coming up as well. All right, so those are some of the features that you can use. Now, anytime that you're just in the option chain as well, Donald, so let's just go to Fossil, for example, and I click on the chain. You can select to view the implied volatility values or the implied volatility range in your data columns on the chain as well, in addition to on the search tool. You could also see those columns there once you selected them using the Choose Columns feature. But something I think you'll find more interesting is, let's go 7 days out here. Anytime you're looking at an option, whether it was on the search or here on the chain or in any of the other tools, when you click the Edit More Information button next to the position, I can go to Research, and I can go to Call Research. This takes us to what's called the Option Quotes page for the particular August 31st, for the 8/19 expiration, 7 days away, for Fossil. And what we see over here on the far right-hand side on the quotes page is, in addition to the probability above and below, you've got a variety of implied volatility values. And what I mean is, you can see right here the current IV of the option, the IV over HV ratio, IV over SIV, the percent implied volatility range, and the total range of the implied volatility since this option was released. And in addition to that, if we scroll down below, on the quotes page, you have a historical chart of options. The default is comparing the option vid versus implied volatility. Implied volatility is in the red. Earnings, of course, came out on 8/9, so we have this volatility crush from 1.22 down to 0.53, and it's dropped down to 0.44. And that's why we're only at 4.8% of the implied volatility range of this option. Down below, I can scroll through the time zone here to see how the implied volatility changed over time. But if I drag the end of it, I can see the chart through the entire time period. And there's a lot of implied volatility leading into the earnings on 8/9 for this particular option. So it was a wide range heading into the earnings on 8/9. It had moved up rapidly. At one point, it was up at about 120 and 122 for the particular implied volatility. Now, when I was looking to do a strangle on Fossil, I knew that I wanted to go a couple strikes out of the money. I didn't necessarily want to overpay. The stock was at $30.70. So I went to the option chain. I went to the strangle search first, but then I went to the option chain. And I started looking at these high numbers. And on August 8th, when I was looking at the chain, so I'm going to go back historically now, one of the other features you can use on the chain. We're going to go back to August 8th. And you see here, look at the implied volatilities for the options that were expiring today. At that time, we're at 1.8857, about 1.7, 1.8 average for the implied volatility in the near term. Go 11 days out to next week, the implied volatilities were about 117%, or 1.17. And all of these ranges, as I researched them, were pretty much the same. They're around 0.35 or 0.4 to about 1.7, 1.17, and so forth. It's too wide of a range. The volatility crush would have destroyed any spread I got into with the near-term options. Even with a 10-15% movement, the volatility would have crushed that. Okay, so I had to go further out, and all the way out to September 16th on August 8th, we're still around 0.7. But the implied volatility range for these options, even though it's not as high as 1.8 or 1.7, but these were still relatively high because we're still looking in range of about 0.35 to 0.70. So to avoid a volatility crush, I went all the way out to December, where the implied volatility is around 0.58. But the total range for the December options was around 0.41 to 0.58. So even if it reverted back to 41%, from 58% getting into it, it wouldn't have suffered as much of a volatility crush as those nearer term options on August 12th. So we see here the stock was at 30.74. Let's just take the at the money 31 call, which was priced between 195 to 235, okay, with an implied volatility of 1.768. We go to the current after earnings came out. 31 strike is only worth 55 cents and 80 cents. And the stock's up $1. It actually moved up a little bit higher. But look at, of course, it's closed today, but look at that implied volatility. It's down to 0.4. That's what happened with the volatility crush. So I had to go out to December to avoid too much of a volatility crush. Because even with a 10 or 15% move, that much shift in volatility, according to the profit and loss chart in the custom spread tool, would not have given me a profit on the position. What do I mean by that? Well, let's go back real quick. I'm going to go back here, and I want to go to the, I'm going to change something very quick here, folks. I apologize. Let me just take out one of these spreads here. We'll take out bull put credit for the time being. I'm going to add back in the custom spread tool just so we can navigate to it quickly. Okay. All right. So let's go to custom spreads, and even though this wasn't the position at the time, if I had to open the August 19th, remember that had a volatility of around 1.17, but let's say that I entered an out-of-the-money strangle with the 32 call and the 29 put when the stock was at 30.70. Okay, now let me go back up here to the chain. Let's take a look here. What I want to do is go to the August 19th expiration for August 8th on the chain. We're going to go historically. So when the stock was at 30.74, my 32 call, let's call it 195, okay, for the strangle, with an implied volatility of 1.18. And the 29 put, that would have been 165 at midpoint, similar 1.17 implied volatility. As we saw today, the current implied volatility, even for 7 days remaining out in time, is only about 0.37, 0.38. All right, so why is that important? Let's go back to the spread. I forgot. Yeah, sorry, folks. If we would have entered this on the 8th, we would have paid 195 for the call. We would have paid 165 for the put. Okay. All right, so I'm just going to roll down here. There's a ton of other questions, folks. I'm going to get to them all today. I'm going to get to them all today. I'm sorry, so let me just finish this up. Here's also a question that came in earlier from one of my customers. How can I use the implied volatility to gauge if I wanted to enter a iron condor or strangle, and how would a volatility crush affect that position, help that position, or hurt it? Well, here, when we enter the trade, we're going to put an average implied volatility of 1.18. So if the stock was at 31.62, the volatility stayed at 1.18, well, these positions would still be to loss. You know, that 32 call that we bought in the 29 put because they were greatly inflated. So remember, the stock was at 30.74. If I expected a 10% increase and the stock might gap up to 33 and the implied volatility stayed the same, we'd still be at a loss. Okay, that was kind of the trick here. So I knew that any volatility crush would hurt the position. I would need a much bigger move in the stock in order to see that. We might need almost a 20% move in order to turn a profit because we overpaid into that position. Okay, but we also knew that if the implied volatility range was 1.18 to, let's say, 0.4, then it might revert back to the means. We saw it go back to 0.38, but let's say it went back to 0.45. after the earnings, well, the 20% gain, we'd have only a $40 gain on the position. Take it back to a 10% gain, and we're at 236. Okay, so why did I go further out in time to December with the lower volatility? Well, I paid a lot more for each option. So my 32 call and my 29 call at the time, I believe, were both around, this was at 325. This was at 245. I think that's what it was at the put. Something along those lines. Let's see. It was about 7. Yeah. It was about, no, it was a little higher. I'm sorry. Let's try. Yeah, it was about 355. Let's do it that way. I think the call was more, but that's closer to the actual price I paid for this spread. Now, at the time I entered the position, the volatility was at 0.58 for both options. And so I changed my time frame here. I saw that, okay, with the stock up at 31.62, where it is now, the expected profit would only be $14. Now, I had to anticipate some crush, so I analyzed it if it was at 0.5, because these farther out options weren't as affected. The range was 0.58 to about 0.48, so I figured 0.5 was good, but with this percent move, we didn't really see a gain on the position. We're losing more on the put than we're gaining on the call. That's why it's better to have more time, because I wasn't affected too much by the volatility, where I would have suffered a $200 or $300 loss per contract with any option, because the volatility crush that was this week's expiration, the 19th, the 26th, or even the first week of September, the collapse here on the farther out option was not as bad, and I still have, of course, out to December to continue to manage this position. Want to know the biggest annoyance about this strangle that I entered on Fossil? After hours, the stock was at 30.74. After the earnings announcement came up, the aftermarket trading at about 4:35 p.m. had the stock up at 33.80. It had moved up the 10% I was looking for. Okay? 20 minutes after that, it reverted back to 32. I don't know why. I don't know what institutions happen. And when the market opened the next day, it was at 31.25, only 50 cents above where I got in. Moved up a little bit after that, then pulled back, and then moved up a little bit today, so it's at 31.67. So this 10% move that happened after hours, I couldn't even take advantage of. That's why some of these things are terrible. But had it stayed at 33.80 with the after hours trading, and it didn't go back down with the volatility of 0.50 and 8.15 today, I'd have only a loss of about 30 cents. And what I'd probably do is sell to close the call, leave the put open, and as the stock pulled back, maybe then sold to close the put and bought another call if I'm anticipating another move upwards as well. Okay, so long-winded answer, but various implied volatility and volatility values are available in all of the searches for all the strategies. Single option strategies give you the advantage of screening by that percent implied volatility range. You can also see it on the option chain at any time, the implied volatility values incurred there, and on the custom spread tool, when you're analyzing maybe a short position, short straddle or strangle, or a long straddle or strangle, you can play around with the volatility. You'll be able to see the true volatility range on that option research tool, so you can see how that would affect your position. Okay, so I'm going to scroll down here real quick. Oh, yeah, there's something here too. For those of 30, thank you. I'm going to the end of the questions here because I knew some people were going to comment on what I was talking about. Scott and I had a conversation a couple weeks ago, Scott, 2 weeks ago, before I went on vacation, I believe. For those 31% of you that are doing the insured position, married puts, collars, and so forth, if you're using the married put, one of the things that I told Scott that I use, because it happened to me on a PLP, El Paso Pipeline, it was LP stock, I'm sorry, years ago, 3 years ago, is I entered into a position, a married put position that had a 7% risk. In the first 40 days of the trade, it was like 38 days into the trade, the stock was moving up as I wanted, but all of a sudden it had gone up about 1.5%, and all of a sudden my put dropped from about $6 to $3.80, and the stock didn't move. What had happened is when I had gotten into the position, the married put initially, I didn't realize that the implied volatility on the put was up near its highest range. And it was a wide range too for a put that's 6 months out in time. It was about from 0.25 to about 0.67. Okay? And so that really hindered me because I immediately lost about $2.20 on the put without the stock gaining or moving. So from that moment on, what I started doing is using the percent implied volatility range, and I typically look for a percent implied volatility of less than 65% when I'm getting into a married put. So I know that the puts that I'm getting into are in the lower range of their implied volatility, and I'm not getting hurt with that volatility crush. Now, it's not going to be as big as what we just saw with the near-term fossil ones, but the problem with being in a married put here, if the implied volatility collapses or drops a little bit, and you lose that kind of money, you're now hindered from using things such as income method number 3, income method number 4, and income method number 9 because you lost $2.20 a time value that you paid into that the stock didn't recover in my case. And Scott had a very similar example. So when you're buying options, it's a good thing to do that as well. Okay. All right. So I just wanted to go back in time there. So now let's go back to the top here. Okay, so I'm sorry, is it Timmy? I can't see the name there. Yeah, it's Timmy. Wanted to know, when my covered stock increases in price, is there a guide about how much increase would it be best to roll the option up? Okay, so there are 3 rules of thumb that you can consider when looking to roll a covered call. There's many different ways to approach it. Let me go to covered call. In the covered call page here, Timmy, there's a couple things here on in the Learning Center. Let's see here. Follow up a covered call position is one, and rolling. But following up a covered call position has some good guidelines on whether you started in the money, whether you started at the money or out of the money, and when you'd look to manage it. Okay, let's go to the custom spread tool again. And let me go to Footlocker. As many of you know, you might have seen some of the RadioActive trades I had this week. It's a bulletproof position going into earnings. I can't lose any money. I've got a guaranteed upside profit potential and an income method number 6 on it right now. Let's say I bought Fossil at $59.50. Not the quantity. I'm sorry, folks. Bought 100 shares of Fossil at Footlocker. I'm sorry, at $59.50, and I sold the August 19th 60 strike call at the time for a premium of $1.10. Okay, and let's say we did this a week and a half ago or sometime within the last 5 days. Well, that's good, and right now the stock has moved up to 61.14. Okay, so why am I showing something that's already in the money? There's 3 approaches here that you want to consider, Timmy. Number 1, if I entered this as an out-of-the-money call, which I did, okay, this is the 60 strike call, was slightly out of the money. I got a pretty good at-the-money premium, 2.7% return for, let's say, 10 days of trading. Not too bad at all. Not too shabby at all. Okay? Now, if my goal was to stay out of the money, because I wanted to hold the position longer term, I'd likely roll the call when the stock reached maybe within 1% of my strike price. Okay, so when I saw the stock maybe get up to 59.60 or 59.70, I could have considered that. Ernie feels, and he's right most of the time, Ernie feels it's better to sometimes let this call go in the money. By the way, I have a 60 strike call open for next Friday's expiration on Footlocker. I have a spread actually in place with a 60, I've sold a 60 call, and I've bought a 65 call for a bear call spread. But looks like I'm losing, but it's done in the context of a married put, so my profit and loss chart is actually something like this, where here we are at 60 and here we are at 65. Now, I looked today to roll that position because it was in the money. It had this stock had a gap up today of about 95 cents and then $1 and then back up to about 70 cents to where it closed today. But I didn't roll this yet. And the reason why is because, yes, it was a big gap. I know that I can be assigned at any time on this position now that it's in the money. But I also feel that it'll probably pull back and maybe drop back down to that 59 or maybe even 58.50 range going into next week. If it continues to move up on Monday, I'll probably consider rolling to the 62.5. So we'll have another spread where I'm short the 62.5 and long the 65 in the context of a married put position. Okay, so it depends on what your goals were to begin with. if you started, this is really not even out of the money, excuse me. This is an at the money call where I'd be looking to maximize the time value. So in this case, I might leave it open, and if it goes to 62, I might consider rolling it. So the idea there is that if you're using an at the money covered call, you might want to consider rolling it as it gets near to the next strike price. And this allows you to take advantage of the at the money bell curve. What do I mean by that? When I sold this 60 call, if the stock was at 59.50, the 60 call is the at the money option. It has the highest time premium of any option in that expiration cycle. And that's our true profit as a covered call trader, isn't it? We can get some growth and some speculation by selling out of the money calls at a higher strike, but the true profit is the time value unless we get lucky speculating on deep out of the money calls for 10 cents and the stock happens to move up 5 points. So, because I want to take advantage of the at the money bell curve, which simply states that the at the money options always have the highest time premium, and in the money and out of the money options have the lower time premium. Okay? But as the stock moves from 60 to 62.5, or 62, the at the money bell curve is going to switch. And now the 62.5 will have the highest time premium, or the 62.5, and the 60 will have a lower time premium. It'll be a higher cost because of the gain of intrinsic value, but if you look at it, I've also gained on the stock in that scenario. You know, if the stock's trading at 62, I've gained $2.50 on the stock, in addition to my call probably gaining $2 of intrinsic value, right? So at that time, when the stock's maybe at 61.80 or 62 or so, I might look to buy to close my now in the money call and sell the at the money to take advantage of the at the money bell curve, okay? If you speculated out of the money with your covered call and you said you sold the 62.5 for more room, then in this case I'd wait for the stock to get up to 62 or 62.25, again within 1% of that short call. If your object is to stay out of the money and try to continue to collect premium and not be assigned, then you'd wait for it to get maybe within 1 to 1.5% of your short option strike and then consider rolling it up or maybe rolling it out in time if you're focused on rolling for a credit. Okay, so those are some of the ideas there. And if you started in the money, if I'd sold the 57.5 because I wanted to be assigned on the position and it offered me a 2% return for 10 days, and now it's deeper in the money, hey, I'll take it. Maybe I'll just let myself be assigned and not roll the position, take the money I made from the profit on the position, and then look for new positions later on. Okay, all right. So another question that came in, James said, he said that he was looking at all those positions. Paul has a long question here, and he's talking about the RadioActive Trades, and I don't mean that to be negative, Paul. I'm sorry if that sounded like that. I'm just, give me a second here to read through the entirety. And Paul wants to talk about the RadioActive Trades, the married put. He says, opening the married put at less than a 5% potential loss is easy. What happens if the option bid-ask numbers, the bid-ask spread of the far-out puts, never work in your favor on a stock to enable you to roll the married put to reduce your maximum risk? I've never had that experience, personally. I've never had something that had so wide of a bid-ask spread that it was actually a negative to me to roll the put up or to roll the put down, okay? He says you picked an uncooperative stock that doesn't move. Okay, there's not enough liquidity in the option, and the S&P moves against you when you're in the initial phase. Do you just live with the original married put risk until it expires? Not necessarily. There's ways to adjust the put if the stock falls, but it's got to be based on your expectation, what's discussed in the blueprint as far as the SIGA model goes. And what I mean by that, there are adjustments, Paul, that we use when the stock falls against us. One lowers the total cost basis in the position, but might increase the percentage at risk. But you have less money in the position, but a higher monetary risk. Others involve potentially playing the downside for higher profit to the downside if the stock continues to fall. That's what's contained in the blueprint. It discusses the ins and outs of all 12 income methods. Of the 12 income methods in the blueprint, really income methods 1 through 6, and we might even consider 11, are used if the stock moves up in price. If the stock stagnates within the first 20 to 30 days, I'll use income method number 7, number 8, potentially number 6, or I might use 11. If the stock falls, I might use income method number 9, combination of 9 and 1, or 9 and 3. Or I may use a combination of income method number 12, depending what my outlook is going further, okay? If I'm in a married put, Paul, and the stock collapses right away, and it just drops 20% 10 days after I opened it, and I don't think it has the potential to recover, absolutely. I may just liquidate the position. I'm not going to hold it until it expires. That makes no sense, okay? That sounded insulting, but I didn't mean it that way. Let me take a look at, give me a sec. Okay, here's what I'm going to do. Let's go to the custom spread tool once again. And I'm going to type in KR, Kroger. I'm going to say that I bought 100 shares of Kroger at $41. At the same time, I bought a January 2017 45 put at the time for, you see, even the deep in the money ones here, this 12.30, 12.90, it's only a 60-cent bid-ask spread. I could easily probably get 12.60 or 12.40 for that without any problem. I know that's not the kind of things you're talking about, but I'll get to that in a moment. Okay, let's say I paid $6.20 for this, roughly. Okay, so originally I had less than a 5% at risk. The stock is now down to $32.58. Lost almost $10 or 25% on the stock. And let's say I haven't made an adjustment yet, Paul. So at this time, do I want to hold it now all the way to January expiration? Well, no. If I don't have any, I mean, Kroger does have earnings coming up September, but if I don't have any expectation that this stock is going to recover, I'll liquidate it right now. Okay? So I'm going to sell the stock at $32.58. Okay, we're going to close the stock at $32.58, I'm sorry. And at the same time, I'm going to go ahead and take a look again at that January put, and it was priced at $12.30 to $12.90. I'm going to assume I can get at least $12.50 for this position. Okay, it's not, the midpoint would be $12.60, but let's say the market maker is troubling me and I can only get $12.50. That's reasonable. Okay, 12.50. So what does that mean? That means if I liquidate the position right now, we're going to get a total value of $45. This isn't great, of course, but $45.08 right now in August. Okay, still 5 months to go to expiration. So why would I hold it this long unless I'm really hoping or I have an expectation it's going to recover? Okay, in this case, why would I hold it all the way to January if I don't think it's going to recover and I'm going to take the loss of 4.7% when I can sell to close the call and sell to close the put right now and still take only a 4.5 or 4.6 loss? Yeah, it's near the maximum loss, even though I have some time remaining. These probably aren't the exact numbers that would have existed, but that's okay. I'm going to liquidate now, use this 45.08 that I have. It's a loss, 4.5%, and then I'm going to look for a better position. Although that's not what I would have done, and that's not what I did do, because I am in a Kroger position that's very similar to this, and the stock is at $32.58. So as the stock moved down, when I got in at 41, as it dropped down about 39 or 38.50, I think it was, I used income method number 9, lowered the cost basis on my position, sold to close the 45 put and bought a 40, and generated about 380 of net credit against my total cost basis, but I did lower the strike by 5 points. So I increased my maximum risk, but I lowered the cost basis on the position. And then as it continued down to 35, again, almost like we talked about the covered call to the next strike, it was 34 really, I considered doing that again. I'm actually back up to holding the 40 call right now, or the 40 put, excuse me, Paul, and I'm going to look to do another adjustment on that as well. Okay, so very rarely, if you do your own search and you're looking for highly volatile securities with higher risk in the 10, 12, or 15%, that's where you typically see the wide bid-ask spreads. Most of the positions that you'll see here in the default criteria that match the radioactive trading criteria, or even if you keep the time frame, the risk limit, and going no more than 2 strikes in the money, you're probably not going to see a lot of positions that have an extreme wide bid-ask spread for the put. And in 8 years of trading the radioactive techniques, I've never had a problem where I couldn't get close to midpoint. Even on one position where it was a $14, $15 stock, I was looking at a 17.5 strike put that was valued at $4 and the bid was 6. I'm sorry, the ask was 6, the bid was 4. Doesn't sound like a lot, but you look at the bid-ask spread to the bid, it's a $2 bid-ask spread on a $4 bid, so it's 50%. I was able to get $5 for it for no problem. Okay, so that's typically what I see because you're looking at the positions that may have a bid-ask spread, but it's not going to be too wide where you can't do it. If you start looking at biotech stocks and taking on an 18 or 20% risk because of the increased implied volatility, that's when you'd start to see those. David says, when you're looking for married puts, is it possible to search for just $1 strikes? Unfortunately, it's not. You can only screen for a $1 strike if you're in a spread. Okay, and the system doesn't look at one strike between the two options. It looks at the one strike between an option you'd sell and an option you buy, or vice versa as well. Some of the lists, I want to see if there's a list here. There was a list for a while. There are stocks offering weekly options, volatility indexes. Just give me a second. Earnings this week, standard ETFs. I'm sorry. Okay, what I was looking for is I know that at one point we offered a list of stocks that offered $1 strikes, but it changed too rapidly, and then there were stocks that started offering 50-cent strike differences. I mean, the list ballooned up to about, I think it was 1,600 stocks at one point, and then they started adding in the 50-cent differences. So I think we removed that list and didn't keep it updated. But remember, at any time, if you do have a list of stocks that you prefer to trade that have the dollar strike difference, just create your own personal list and screen against those to help you save time. Oh, okay, so James is asking about one of the new features on PowerOptions for both covered calls and naked puts. Let me go back to other strategies again very quickly. Default strategies, there we go. I'm going to reset to the default strategies. So two of the new features that you have in the covered call search or the covered call strategy and naked put strategy are picks of the day and weekly picks of the day. James' question is, have you back tested those? I didn't, but Ernie did. The whole reason these picks of the days are here, and it's a full description here, Ernie spent time going through all the criteria as best he could for covered calls and for naked puts right now. And he did different tests with a different backtesting module that we have that he's using right now and that he uses for our other two products, the strategy optimization and the historical testing. One's $50 and one's $500 there. But what he did essentially is he started off with a base set of criteria for covered calls and naked puts, and then he started tweaking them and running the results over a 2-year, 3-year, 5-year period, I believe, on some of these. Some of these I think are only 2 years, but 3 or 4 years, and then 5 years as well, to see what return would yield the highest. Okay, and what he found is he even put stops in on some of these positions and didn't put stops on the other, and found out which ones would give him the best return consistently and the highest return over that time frame using these criteria. Okay, and that's what's discussed here. Okay, these picks have been the highest percent naked yield returns. This is for the picks of the day for naked puts. Stocks are in the list that he decided to use in an uptrend. Options were out of the money by more than 6%, greater than 40 cents premium, and have an IV of less than 1 to avoid biotechs. When we included biotechs, the results were worse. Okay, those crushes really hurt over time. So these are the results that he's back tested. The weekly picks of the day, you're going to see something in probably 2 days. All right. Ernie wrote a blog article on exactly his process of going through the weekly naked puts, which is the same process he used for the weekly covered calls, why he picked them. Okay. The weekly ones are for a short 4-day time frame. Expiration is 0 to 8 days. The income is generally lower for the weekly selections, so we have to put a minimum of 20 cents. Stocks are required to be trending up, a 20-day moving average, growth of greater than 5% for some of the technicals, and of course, since it's a weekly, we couldn't go more than 2% out of the money and still get a positive gain over time. Okay, so you're going to see some write-ups on these in a couple days, but yes, to answer your question, James, the picks of the day, the weekly picks of the day, the covered call weekly picks of the day, and the covered call picks of the day were all backtested historically by Ernie, running through different examples, using different criteria and different stops as well. Okay? All right. Sam mentioned a question here. This was a while ago. I did miss it. Sorry about that, Sam. He says that means that if this was going back to our discussion, I'm sorry, folks, on the strangle on fossil. You're absolutely right. What Sam said is that means if you sold the volatility, you could profit of it. That's right. But looking at the numbers, however, even if I sold it with the 32, remember I still was buying a 32, I would have sold a 32 call and sold the 29 for a high premium. If the stock did move up 10% as I expected, and it did after hours, but didn't hold that because, that's how the market treats us sometimes, I would have lost on, I would have made money on the August 12th, August 16th, and yeah, August 12th and August 16th short strangle with a 29 and 32 put, but I would have lost money on anything beyond that on a short strangle. Because the movement didn't happen, okay? So that was the trick on that, if it moved up 10%. So remember, it wasn't only just what happened, Sam. My expectation was that it was going to move up 10%, okay? All right. Jim says, is watching that volatility range covered in the blueprint? It kind of is mentioned. Better place to look at it is right here on PowerOptions, honestly. You go into the free webinars, right is that percent implied volatility range, and two things here. Number one, if you wanted more information, you could look at implied volatility, the double-edged sword, under the options concepts. We discuss the implied volatilities there. In the option strategies, power options for radioactive trades, I do discuss that. But here's the thing, Jim. The simple discussion I just mentioned when we were talking about the percent implied volatility range for married puts and limiting it to less than 65% is the exact same thing that I discuss here. It's no difference. I don't track it after that because I don't care. Yeah, I honestly don't care. I'm more focused on my percentage at risk. It doesn't matter to me if I entered it correctly and that volatility range was in the lower 65, 40, or 50%. I don't care if it falls to 20% because I'm more focused on what my risk was to begin with, which would have only been 4, 5, or 6%. Okay? And if the implied volatility increases when I'm in the trade, that means either the stock went down, so I'm going to just approach it as the stock went down, following the rules in the blueprint as well. And I'm sorry, and so in that case, when it expired, when it ran out on me as well, no, sorry, when the stock fell and implied volatility increased on me, well, that means the extrinsic value of my put option increased in price, although, you know, I'm gaining some intrinsic value too, which can happen. But I'd approach that as closing the position or rolling it as I would as just the stock being down, not using the percent implied volatility range or the current implied volatility as any means as a judgment to roll the position or not, or adjust the married put position. Okay, Robert says, I missed your 5% in a month webinar. It was one of the webinars that I put in recently on last Tuesday. Am I showing the right screen still? Am I showing? Yeah, okay, I'm showing the webinar screen. Just give me one, you know what, I'm sorry. Robert, what I'm going to do is I'm going to send you the link to that. I believe it's available it's available on YouTube, so you can check that out at any time. So after the webinar is done, I don't have the exact link right in front of me, but I'll send you the YouTube link for the Footlocker trade, where it's it could be liquidated for a 5% profit, guaranteed return of 1.8%, even if the stock dropped to 0, and I could make infinite potential profit if the stock moves up as well. Okay? All right. Let's get back up to the top here. Okay, let's see here. Oh, Sam says if the Kroger position doesn't recover, you could do that, a credit spread on it. That's exactly right. Yep. And now I could do a credit spread. There's other adjustments I'm looking at as well. Okay. Okay, another quick question. Paul asks, what is the reference to the performance guarantee? This is on the trial related to power options. We're investors ourselves, okay? And so I even mentioned to you, and James, when James asked a question about the weekly picks of the day, you know, that there's the historical testing and what has worked for me. Let's say what has worked for me in a strategy, say standard collars, Paul, married puts, or something along those lines, worked for the past 6 months. But the next month something happens and the same criteria used that have been successful over 6 months, over 5 years, realize the loss. That can happen. We can't give you your money back for what you lost in the market. That is your responsibility. What the performance guarantee states is that if you're using the power options tools and you're following, you know, some of our guidance and our education, we feel confident that you should be able to profit, you know, even a small amount. But what the performance guarantee says is that if you don't make a profit, of course, during a given month using power options, you can email us in and we'll give you your next month free. All right, so it's just, that's all we're saying, is that I've even had months where things that have worked for 7 to 8 months on a reasonable level and a reasonable return, and just 1 month I have a 10% loss. That can happen. That's the way the market goes. That's one of the reasons why I trade with married puts as well. So you can read all of that if you just click on the performance guarantee. It'll kind of give you a description there. We can't promise that everyone will make a profit, but if during any month you do not make at least 3 times your Power Options subscription fee, your next month's subscription will be free. In order to do that, you have to call us. Now, of course, if you request 2 or 3, or really if you request 2 guarantees in a month, Ernie and I are going to request that you give us a call, schedule a coaching session so we can see what you're doing, see how we can help you, because if you're not making money and we're giving you 3 months of service, neither one of us is making money and you're still losing money. So we want to make sure that we can help you have a better return there so the trading is working for you and the relationship is working for us as well. That's the performance guarantee. All right, Dan says, I believe the RPM is the only strategy that beats the martingale. So my question is, how much capital do you recommend one very frugal person need to make a living out of doing an RPM? Okay, here's the only explanation I can give on that. I can't guarantee what profits you're going to make, Dan, on a radioactive trade portfolio, married put portfolio. Okay, I'm agreeing with you that the RPM is the only strategy that beats the martingale unless you're extremely disciplined with some other strategies. Here's the catch. In the last 8 years, on average, Ernie and I've been able to see it, but you know, on average, I make about 1 to maybe 1.5% per month. I know that does not sound exotic, but here's the thing. After spending 1.5 years trading covered calls, almost 2 years trading naked put strategies, 1.5 years trading credit spreads mainly in my portfolio, 9 months to 10 months doing calendar spreads, also doing straddles and strangles and rolling positions, the only strategy, even the standard collars, okay, which I still trade, and I have about a 66-67% success rate with, the most consistent strategy that has yielded consistent profits on average year after year has been the radioactive trades and married puts. Collars still work out for me, but not as much. Okay, I still make a good return with collars. It's more around 0.8 to 1.2%. Why am I not looking at these weekly strategies that offer 3% for a 4-day trade, or even leveraged spread trades that might offer 12% for a 4-day trade? Because long term, I've never made them personally work out for me for consistent profits year over year. Okay, it's as simple as that. I do trade spreads still with about 15% of my portfolio on broad-based indexes and ETFs. Some are weekly, some are usually 2 to 3 weeks out in time to get a better premium. But I don't do a full spread portfolio because I was never able to make that profit long term. So to answer your question, I really can't. So here's what I'm going to say. My expectation, what Ernie feels is possible, we feel is realistic, that with the radioactive trades, you should expect to average maybe 1 to 1.5% per month. I can't guarantee that you're going to be able to do an income method and make 1% per month. My returns on this are based on if I stayed in a radioactive trade for 3 months, I might not do anything in the first 20 to 30 days, do any income methods or generate any income, but in the second month I might collect a dividend, the stock moves up, I do an income method, I roll the put up, and then in the third month I'm able to liquidate the position for a 4.5–5% gain. I didn't really generate 1% per month, but I averaged 1% per month, 1.5% per month when I closed the position for 4.5% gain 3 months in. Okay, so all I'm saying to you is that if you think that's a reasonable average, which Ernie and I feel is that 1 to 1.5% per month on average with a radioactive trading position, that's the only number I can give you. And then what you have to figure out is, what do you need to make a living? You know, in other words, if you need to make, or you want to take in trading, let's say $4,000 per month to quote unquote make a living with radioactive trading, then you have to figure 4,000 is 1% of what, and that's probably what you'd need to invest. Okay, so it's based on what you consider the money is to make a living, and I'm going to say that 1 to 1.5% is reasonable expectation. Okay. David, I understand. Okay, David says, I hear you using IM number 1 and number 4, 2 and 6 just as examples. Can you say how difficult it is to determine which to use after buying the blueprint? I make it sound easy. I know. I've been doing this and teaching this for 8 years, so I probably have a better grasp on it of anyone over Kurt and actually 1 or 2 of the other radioactive traders who I think are actually better than I am. They bought the blueprint 4 or 5 years ago and I think apply it better than I do. Ernie is actually a better radioactive trader, I think, than I am. I think he has a higher return on his portfolio in Fusion. I'm not in a comparison with him. I have to trade smaller stocks based on my account size. But in addition to that, when I'm throwing out these numbers, sometimes Ernie gets a phone call and he says, Mike, I've got a customer here asking me about income method number 5. Can you take that? You're a little bit better at that particular ratio spread. And that's just because Ernie doesn't usually trade that one in his account. So, do I feel it's easy and second nature? Yes. Am I confusing maybe one or two attendees who already came into the webinar and left by throwing out these numbers that don't make any sense? Yes, I am. But I'm also doing it for a reason. You know, I can't tell everyone what income method number 1 is, what number 4 is, what number 2 is, what number 6 is, what number 3 is. I have shown several examples during webinars, and I have no problem showing examples of some of those. But I can't give everything away because that's why we sell a product to stay in business. So I can't give everything away for free. David, I know it sounds complicated, but I think it's really easy once you go through the blueprint and once you start looking at some of the blueprint owners only webinars that Kurt has on RadioActive Trading to get more of a gauge of why I would use this income method over the other one. And at any time, as a blueprint owner, you can send us an email, give us a call. We'll look over the trade and say, okay, here's your pros and cons if you considered X, here's this if you considered Y. I had a customer yesterday on a coaching session who wanted to compare income method number 1, which is just selling a call against the married put, versus income method number 6, which is entering the bear call spread I mentioned, which I have on Footlocker. And let me show you what that is real quick. I think I have it here. But in any case, what we review is why would we use that position? Why does income method number 1 make sense? Why does this one not make sense? And so forth going forward. Okay, so here's the married put that we could have opened on Tuesday that we did in the webinars over the week. And yes, Robert, I remember to send that to you. My actual trade after where it stands right now, it's a cost base of $55.30, and I think I only paid $4.25 for this put when I bought into when I rolled it back up. Let me take a look here. That's about right. No, it's a little bit too high. So let me go $4.75. All right. Not high enough. Sorry, folks. I'm going to go back to this price. Let's just go here. That's probably about right. Now, this was my married put. After doing some adjustments, beginning of July and middle of July, I think end of July, this was the married put position I had to reduce the risk down to 1%, and I think I was going to collect a dividend in the next couple days. Now, going forward, I looked at August, and what I was able to do at the time, it's moved up against me, but I entered an income method number 6. Here's what I did. I sold the call, the August 60 call, this is back in July, for $1.43. That's not right. This has to be higher, so I apologize, folks. I'm going to adjust this position one more time. I'll try to get as close to the value as I can. This should be 105. That's what it is without that. Sorry. I'm going to put 485. All right. So anyway, that's pretty much close. Okay, so at that point, if I sold the call, I had a guaranteed profit of 2.2%. So if the stock collapsed at earnings, which were on August 19th at expiration, if the stock collapses, I'm guaranteed to make a profit of 2.2%. The max return, if the stock was trading right at 60, would have been 9.3. But if the stock moved up, if it gapped up to 62, 63, 65, or 66, I'm giving a lot of that back. So when I'm approaching this position, what did I have? Every income method in the blueprint discusses a SIGA model. And what we call the SIGA model is what are the current conditions, what are your expectations, what are your goals, and that determines your actions. So the conditions were I'm in a married put that has about, at the time, had about a less than 1% risk. And the put was, oh, I'm sorry, I have the wrong put. This is actually a November put. My apologies, not the January, but that's okay. So I had about 3 months to go to expiration on the put, less than 1% at risk. And I'm going into earnings. So what does that tell me right away? That I have a low-risk married put, but I'm going into earnings where the stock could go this way or this way. So I want to make sure that I leave upside profit open and potentially downside profit open as well, or at least keep it in a bulletproof status. That's important. So what are my expectations? Well, honestly, my expectations are the stock's going to be trading at around somewhere between $59 and $61 as I go into earnings on August 19th, and then the stock has the potential to gap up or down 7 to 8%. So I want to be in position to take advantage of that going forward. I know it looks like I drew a little man there, but that's what I'm looking for. So you see, this is what we're talking about with the SIGA. So my expectations are stock remaining in a tight range going to earnings. This one's a little bit more complex of an expectation, but that we could swing 7 to 8% up or down at the earnings on August 19th. Okay? I know it's always hard to pick the actual expiration day. What are my goals? To guarantee profit to the downside, leave the upside open, guarantee downside, I should say, okay? Leave upside open. That's what I want it to be in position in. Leave upside open, okay? And my actions, well, whatever matches that would determine it. So does income method number 1 solve my expectations and my goals? Well, if the stock swings down 7, 8%, yeah, I've guaranteed a profit. That's a check. But I didn't leave the upside open. I could still make a profit, but I'm going to be leaving money on the table if it gaps up 7%. So I didn't satisfy the second part. So that didn't do the trick. Okay? So what's another way that I can take advantage of this? That's income method number 6. Instead of just selling the call, all right, what I'm going to do is go ahead and buy, at the time bought the August 65 call, which was priced at 25 cents. So I got $1.18 credit for the bear call spread. That part right there, this is a bear call spread done in the context of a married put. Because it's done in the context of a married put, my broker just sees this as a covered call. I don't have to add money to cover the obligation that's 5 points. My upside is unlimited. I have a guaranteed return even if the stock drops to $40 or $45 per share, and then the infinite upside if the stock gaps up. Okay? So that's what I decided to do. That was my SIGA model. 6 matched that better. 5 didn't match it because it also capped the gain. 3 didn't match it because it didn't give me enough bulletproof status that I got with this particular position. The way I got into this position, by the way, was with an income method number 12, which means I had 2 puts. And the reason why I didn't do an income method number 12 going to earnings, which would have created for me either a synthetic straddle or a synthetic strangle, is that because of the cost of the extra put, I did have an upper and lower break even where I didn't satisfy the need to have a guaranteed profit no matter what the stock did. This would actually put me in a loss if the stock stayed between 63 and, let's say, I think it was $58 per share. So if it's a wider gap down, I'd have a much bigger profit to the downside. So wider gap up, I'd have a good profit to the upside. But if it stayed between about 63 and 57.90 or so, I could lose money on the position, and I didn't want that. So based on what I wanted to see, this is the profit and loss chart. This is my current position on Foot Locker going into earnings next week. And as I mentioned, the stock moved above 60. I haven't rolled it yet because I think it has the potential to pull back next week. But whenever I open a spread, whether it is a credit spread or whether it's an income method number 6, I go 2 strikes apart so that I have the extra roll opportunity to buy to close the 60, which we saw would be about $2.20 now, and then sell to open the 62.5. So I just have to move one of the calls instead of paying to move both of them. So I'm just going to move the 60 maybe to the 62.5. It's 1 roll, 1 commission, and now I'm in the bear call spread with a 62.5 and the 65 that I already had open, and I still get that same profit and loss chart and be bulletproof by about 0.5% because I'm going to lose money for the roll, but then my return here would be higher if it did move to 62.5. Okay, so that's what we kind of look for. That's what the SIGA model is. I know that probably sounded more complex to you, David, than it seems like, but that's when you start going through it as well. Okay. Sam was talking about his VRX trade where he says it's a 25%. Michael says, are there any studies on using a married put by adding a 1-to-2 ratio above the stock price won't collect a decent credit? Would this not lessen the downside risk and enhance the upside? There's no study on it, Michael, because there doesn't need to be. What I mean by that is that hardly ever will I open a married put off the bat and be able to do an income method number 5 at a credit. Usually you have to wait for the stock to move up to see the credit with the income method number 5, even if trying to force the midpoint prices. Kurt did do that way in the past. He did an example over a 4 or 5 month period. I don't know the time frame in his track record on RadioActive Trading. I'd have to look it up. But he opened positions by starting off with income method number 6s and income method number 5s because he got so many questions about it. So he said, okay, I'll do it. I think it was about 55 to 60% of the positions he opened that way would have done better had he not done an income method right off the bat. Some would have some lost anyway. The stocks fell, so he lost a little bit less than if he just had the married put. Others, he missed a lot of upside by doing that. So we've just decided that it's always best to wait. Remember, you're asking the right questions, don't get me wrong. And you can always test it yourself. But remember, what you're seeing in the blueprint, if we felt that it was positive and quote-unquote better to reduce the risk right off the bat by doing it out of the money, income method number 5 or income method number 6, and only taking in 5 or 10 cents or 20 cents of net credit, you'd see that. You'd see that in the blogs. You'd see that in the blueprint. But after 12 years of Kurt trading this, 8 years of Ernie and I trading this, we've all tried different things and all tried different ways, and we don't feel it works out better long term. So as much as you want to try to lower that risk originally, and you say, oh, well, if I collect 15 cents for this bear call spread, which is 15 cents I didn't have when I opened the position, we found that long term that doesn't work out. You're better off not doing it, waiting it for better. Leo asked, do you trade multiple smaller RPMs or single larger ones? Leo, I trade multiple smaller RPMs. Let's just take a look here. I'm going to go to RadioActive Trading very quickly. We'll probably be here for about another 10-15 minutes, folks. I know some of you may have to leave soon because you're scheduled to be here at 4:30, but I still have several questions left I wanted to get to. And I appreciate you all staying, and I, of course, appreciate all your questions. Sorry there. Let's take a breather. Logging into Fusion right now, folks, ladies and gentlemen. Might as well talk about Fusion while I'm here. Let me clear up those drawings as well. All right, so let me go to the track record. Okay, and to answer your question, Leo, you can see it right here on the track record. My portfolio is just getting started. My portfolio focuses on growth stocks and sometimes a little bit more volatile stocks, usually between $15 to $45 per share, although such as Foot Locker, and a couple years ago, or a year and a half ago, it was Johnson & Johnson, the $70 range. I'll enter ones in there. I follow the rules in the blueprint pretty much to the letter to ensure that no position ever exceeds 10% at risk. I've increased my risk using income method number 9, rolling down the put, but I try never to go above 10%. The reason why am I only doing 50 to 45? Aren't there better stocks in the 80 to 90 or 100 range? There might be. But personally, Leo, since I'm trading with an account size of about $42,000, $43,000, well, that's what I'm allocating to RadioActive Trading. Actually, it's about 50 to 60% of my portfolio value. So it's actually really more along the lines of, I apologize, folks, about 31,000. But in any case, I'm looking at the lower price stocks because I want to do maybe 200 or 300 shares. We just post in 100 share blocks. But I don't typically want to do just one trade at a time. I usually split up my portfolio. So some of my stocks in the RadioActive portfolio are going to be dividend-paying stocks. Some are going to be larger, more volatile moving stocks that I might use for income. Some are popular growth stocks where we think, Foot Locker isn't one, but thankfully when it had that depression from its last earnings, it's rebounding nicely. This one, I'd probably expect Foot Locker to show some good earnings on Friday, but who knows, right? So that's what I feel personally. And I talk to investors on a regular basis who call up and say, well, I don't have a lot of capital. I was thinking about just investing $10,000. Should I do 5 trades at $2,000 that are all under $20 per share, or should I do 2 trades at $5,000? My best advice is maybe do both. Okay, maybe looking at 10,000, maybe do 1 trade that's in the $40 to $50 range, and then 2 trades that are in the $15 to $25 range. Now you've got 3 trades open on different stocks, and try to branch that out a little bit. Do I think it's better to do, if you really were bullish on a stock that was trading at $80 or so, or $90, and you only had 10,000, well then you might want to do 100 shares and 1 put of that. But in general, I like to mix it up, do some lower price stocks, but not too low. What do I mean by that? I don't want 10 positions at the $10 price range. Okay, if I had $10,000 to invest, I wouldn't open 10 positions in the $8 to $10 range. I'd have 5 positions maybe in the $15 to $30 range, or maybe 4 positions, maybe 6 positions, depending on which ones I selected. Dan said, thank you very much. Will this be available for, yes, I am recording this presentation. It's going to be available later on as well. Okay. All right. Sam had another comment there in relating to the straddles and strangles. And yeah, it's a conversation I did have this morning, and I don't feel bad that I missed money on Fossil. I mean, sure, you don't want to look a gift horse in the mouth, but you're absolutely right. I would have made more money on Fossil even with the December series had I done it as a short straddle or a short strangle. But remember what I said at the beginning. I don't do short straddles and short strangles. Okay? I don't do them even though it would have worked out because I don't want to take the chance of that infinite risk to the upside or the infinite risk to the downside. I don't want to have two naked options open in my portfolio. It's just not how I like to trade. What I think would have also worked for me, Sam, which would have been a good trade, you had mentioned I could repair that spread as well as the married put with a credit spread. You're absolutely right. There's a couple things I can do there. The best trade I think that would have worked out for me long term, and we'll see, but probably with Fossil where it was, would have been to maybe buy the December options that I did, but sell closer in ones maybe at the 31 strike and the 30 strike to sort of create a double diagonal. And if I had to manage one of the short options, I could leave the December options out there and just keep treating it as a double diagonal. That probably would have been profitable now and probably even more profitable long term. And Michael, you bring up a great point. Michael says it seems hard to open low price stocks in the married put technique and keep the risk under 8 to 10%. Yep, that was sort of the experience I felt too. But remember, when I started 8 years ago, I did only allocate about $65,000, $7,000. So I made the decision not to do 2 stocks at 35, but to try 4 at about $17 or $18 per share, or a little bit under. That's what I want. I want to have at least 4 stocks in there. So I was looking in that price range when I first started. Not under $10, but lower price ones. So let's take a look here. Let's see what we've got. I'm not going to put in any restrictions right now. We're going to go to married put, and I'm just going to open up the search. Okay. And I'm going to clear out the search entirely. Why am I in bear call spreads? Silly, silly Friday, Mike. Okay, let's go to married puts and let's go to search. All right, let's clear out the settings. And just going to empty everything out of the parameter field. I'm going to put in the 3 core principles of radioactive trading. I want to be at least 150 to maybe 600 days out in time or more. Percent implied volatility range, less than 65%. Maximum risk. Let's leave that less than 15 for right now, okay? And the percent maximum risk, of course. I'm still not going to go more than 2 strikes in the money or more than, let's say, 20% in the money. To keep things small, I'm going to limit it to 1 result per security. Fundamentals, let's say under $20. Let's call that a low price stock. Let's see what we've got. Remember, I only checked 1 result per security, so it's not going to show me multiple. So there's 285 positions, and notice the first page, everything is beyond what I'd look at for a radioactive trade. Well, I'm not even sorting by percent risk. Let's sort it by percent risk, lowest to highest. Okay. So page 1, everything is above. Whoa. Oh, James to come back in? James says he lost audio there for a second. Okay. All right. Okay, so I'm sorry. So there's 400 total results of the stocks under $20, but I didn't restrict the risk, right? And there's things in here I've never heard of before. Lending clubs in there, I've heard of that. Dynegy, E-Square, Persian Gold, Sangamo Biosciences, Sears Holding, that's always all over the place. New Park Resources, okay. But we know there's some out there, so let's put it back to the radioactive trading criteria just as far as the risk goes. So I'm going to go 3 to, let's go to the upper range, let's go to 9%. Usually I keep mine around 8%, but let's go to 9. There's 411 results, but notice how many of them are up in the 9 range. Let's take that back down to 8, 8.1. All right, 3 to 8.1. All right, so good stuff, 399 results on stocks under $20. Eldorado Gold is an 8.1% risk using the 5 strike put option for January. Now, I'm not using any of the lists, remember. It doesn't have to be an IBD 50 because, to tell you the truth, you know, the default criteria looks for the IBD 50 and CanSlim list there, and you're not going to see a lot of low-price stocks in those lists. But I do want to probably see some other things, okay? And so what I would look at is fundamentals. We already saw there we were keeping the stock less than 20. But I might want to try to look just for mid to large cap stocks. And I want to see something with a positive earnings per share growth. Let's just go greater than 0. Normally I'm greater than 5, but let's go greater than 0. 91. It's a good cut down. Okay, so it's still a lot of ones that are in there. Cypress, Calpine, Apollo, Huntsman Group, Ally Financial, things of that nature. But I can look for other things as well. If you want to look for an average stock volume, let's say greater than 750,000 shares per day. If I wanted to look for stocks in an uptrend, we could put that in there too. We've narrowed it down to 80, but the risks are still relatively high. Let's take our counting one more time real quick here, a couple more questions, and then we'll close out for the day. Let me go under 5. All right, so you have 38 results that have a risk between 3 to 5% in the time frame we want, low implied volatility range, some basic fundamentals. These are also, let's take a look at one here. That one looks like one that's probably there. Radian Group at 260, it's a 4.9% risk. I'm just curious. Let's go to the option research. Those ones with the higher risk, by the way, that were the 11.9% would have a wider bid-ask spread. This one's not bad. It's bad percentage-wise, right? The bid-ask spread here is 210 to 260. It's a 50-cent bid-ask spread. Well, that's about 25% of the underlying stock price or underlying option price, but that's not too out of whack. I could probably only pay 250, maybe even get 240 for this, which wouldn't be bad at all. It'd reduce my risk a little bit. So it's hard to find some ones there. What I'm just showing you is that there are, I'm sorry folks, that just went off. There we go. There are ones that you can find, but you're right. You got to make sure that the criteria you're using are stocks you trade for married put, and that's when we're going to take it to a lower range. Scott says, does Ernie suggest buying a put on any of the weekly naked puts? No. What Ernie's creating, I'm going to be honest with you guys, okay? I'm always honest with you guys, but I'll be upfront with you guys. The reason Ernie created, right now, we're going to do it for other strategies, credit spreads and other things there, but the reason Ernie created the picks of the day for the covered calls and the naked puts is because when new trial members and subscribers come into PowerOptions, there's a survey there that says, you know, what kind of strategies are you interested in? And the largest proponent of new members who come into PowerOptions are doing covered calls and naked puts because that's all they're allowed to trade, because they're just qualified for level 1 trading. They're just getting started out and they're qualified for level 1, which allows them to do covered calls and buy puts, but they're focusing on covered calls. So Ernie's idea was to work to make it easier for someone new coming in to just say, okay, what would the picks of the day be and the weekly picks of the day, so they don't spend too much time going through the search and analyzing it and trying to figure out what had happened and what worked best for them. Okay, so that was the idea behind the picks of the day, is to make it more streamlined, even for our long-term subscribers, many of which, there are many long-term subscribers, by the way, who've been subscribers to PowerOptions longer than I've been working here. There's a customer I talked to the other day, no, last week before I went, 2 weeks ago before I went on vacation. His name was John. John has been with PowerOptions longer than I have. All he did was call to update his credit card. He logs in about once or twice a day on average, it looks like, not including the weekends. It looked like over the time period from about 1998 on that he averaged 1 or 2 logins per day. To tell you the truth, I have never talked to this man before. I never had a coaching session with him. I don't recall any phone calls I've had with him in the last 15 years. I don't recall answering any emails from him. So he's set in his ways. He knows what he wants. He knows how to use the site probably better than I do, and I've just never spoken to him. The only time I spoke to him was when he needed to call to update his credit card, because for some reason it timed out on me when he was trying to do it on the website. But even for someone as advanced as that has his own method of going into PowerOptions, knows exactly what he's looking at, exactly what he wants to do, has his alerts set in his portfolio, and that's all he does. He doesn't need help from me or Ernie or anyone else to do his trading. This is also streamlined for him as well. If he's doing covered calls and naked puts, he can just check the picks of the day at any time, see which ones are there. But because this is how it was designed, Scott, you know that I advocate radioactive trading and standard collars and protected positions. I do trade credit spreads and other strategies in my account, including calendar spreads as well. But for investors who just want to do covered calls and who just want to do naked puts, we're not going to try to confuse them. Now, by saying that, oh, you want to add a long put in it. Now, if a customer calls me up and says, I've been trading naked puts, I've been following the picks of the day, they've been working really well, but I had one or two that went against me, what could I have done to better protect it? Then I would reference them to maybe look at a bull put credit spread, maybe look at a calendar put spread, maybe the management techniques. For example, if you go into the Learning Center, if you go to the free webinars page, you go to option strategies, there's a full webinar here on managing your naked put positions, exactly what I do in my portfolio and other means that I don't use in my portfolio as well. Okay. Dan asked an interesting question. It seems like you get more success doing RPM on stocks that have a higher price since it doesn't have to move a lot to make a significant result. Is this correct? Tough question. I'm going to say most of the time, but three of my top 4 percentage returns with RadioActive Trades since 2008 were on Silver Wheaton when it was on $17, Kraft when it was at 28, Avis when it was at 29 or $30 per share, and not PXP. PXP was at 30. There was another one, I can't remember the name of it. It wasn't Talisman Energy, which dropped down to 0, and it wasn't Office Max. That's not a fair comparison because Office Max was one of the ones that dropped about 60% on me, but I made a 1.8% profit using the techniques. Yeah, so 4 or 5 of my 4 or 5 last big profitable trades. Silver Wheaton was at $17 when I opened it, and it moved to 40. I'm never going to be able to repeat that return, honestly, with an RPM. It was a 58.9% return in a 5-month period. I don't expect to ever achieve that again. It's possible with the setup, but I don't think I'm going to. Kraft was actually around a 20% return, 18 to 20% return. Avis, I believe, was a 14% return. Johnson & Johnson was a 12% return, which was a $70 stock. And although we saw the position, for Foot Locker, sure, I could liquidate now for about a 5% gain. I'm guaranteed 1.8% profit, and I have infinite upside. The put's out to November. So even after the earnings, I'm still probably going to trade this for another month, month and a half. My goal here for the Foot Locker position is double digits, around the 10% gain. Because I figure I'm going to be at about 7% after August or 8% after August, and then I'm going to try to get another 1 or 2% between September and October to get that to a 10, 11% gain. I can't control that, but that's what I'm looking to achieve with this position, and I'm looking for the income methods that match that with the SIGA models we mentioned earlier for David. Okay. So yeah, I hope that answers your question there in regards to, I went roundabout there. I apologize for that, but I hope that answers your question in regards to both what we're doing with the naked puts. They're the picks of the day. We're just treating it as a straight strategy for an investor who wants to trade it, without getting confused by saying, oh, and doing this and doing that. I'll tell you this much, though. In relation to when Ernie starts doing the searches for the bull put credit, my advice to him is when he starts doing his historical testing, I'm going to tell him to use the exact same thing he's doing for naked puts, but just add the extra put to it and use that as your benchmark. All right, so the naked puts today, the weekly picks of the day come up, let's say, with, VRX. That's something I think that Sam was referring to, the VRX position. I don't think it worked out for him, is what he said here from the picks of the day. But let's say right now I saw this VRX position. By selling the 24 put, I might consider, using the same search criteria for a bull put, but maybe adding the 22 put as long as the return stayed, the net credit stayed, let's say, above, I'd have to say 35 cents or so, and the return was in the 8 to 10% range minimum for the bull put. That's where I'm going to tell him that that's the easiest place to start as a benchmark, see what your performance is, and then work to improve that. Because already proven it works for the naked puts, so just adding the extra put below it, using some margin, should kind of work out just as well, I'd think. But we'll see, because Ernie usually gets the best of me. That's why he's the experienced master, and I'm still learning from him every day. All right. Well, ladies and gentlemen, it's close to 6 o'clock Eastern Time. I don't see any of the questions come in. If I did happen to miss a question, if you sent something in and I accidentally glossed over it and moved it, go ahead and send that back in, because I didn't intend to skip over it or miss it. It's just that when I was answering questions and deleting one, I might have deleted 2 by mistake. That sometimes happens when we're on the presentations here. And of course, for those of you who are wondering, if you haven't done so yet, remember, just go to powerop.com and you'll see the form there to put in your name and email address to get your 14-day free trial if you haven't done so already. After the 14-day free trial, of course, we do also offer the end-of-day service, which is $40 per month. It gives you access to the tools on PowerOptions, but with end-of-day quotes only. Then we do have the 20-minute delayed service, which is $60 per month. The 20-minute delayed plus historical, which is $100 per month. So you get full access to the historical backtesting tools. We saw a little bit of that on the option chain today. But going forward, of course, you can go back 8 years, I think actually back to April 2006 with the historical tools. And then the real-time service, of course, the full service, the real-time plus historical, is $160 per month. Now, I don't have the right ones here, but I know next week, Tuesday at 12 noon, we're going to have another RadioActive Trading presentation. I'll probably have a strategy presentation for PowerOptions Wednesday. And then, of course, on Friday, we'll be back for another open discussion. James did mention something. I thought I talked about that. He said the inverted iron condor on fossil may have been cheaper than a strangle. You're absolutely right, James. I thought I did address that. I guess I didn't. The inverted iron condor probably would have been cheaper. But again, it's not a strategy that I like to trade on a consistent basis. And again, although the inverted iron condor probably would have cost less and would be showing a profit right now, no, you're probably right. It would have probably been better. I'm sorry, James, you're right. Now that I think about it, I'm just graphing it in my head from what I had entered the positions in. But I think you're right. That one would have worked better as well. But when I looked at it originally, using the December options and expecting about a 9 to 10 to 11% gap one direction or the other, and the volatility only dropping from about 0.5 to about 0.4 or 0.58 to about 0.5 or even to 0.49, I would have had a profit on the long strangle. But it didn't work out that way. But I'm okay because you're right. Now, James, remember, I'm still in the strangle. I haven't closed either leg yet. I feel no panic to close this spread because it did or didn't work out for me. I've got till December. I'm going to cross a whole nother earnings with fossil as well. So you're absolutely right. And what Sam mentioned earlier, you're right too. There are ways to manage that. I can add a credit spread to the middle of the strangle right now. I could just do a short strangle short term now that earnings have passed. Volatility isn't as high. But I could kind of do that inverted condor or do a double diagonal now, even though the volatility is lower for the shorter options because I have the long options already in place. Or I could adjust one of the two legs. I could adjust the put leg or the call leg I'd rather adjust to get a lower cost basis and then maybe do the credit spread inside of it or the short strangle inside of it to kind of create that double diagonal or the inverted condor. A lot of ways to play it. So I wanted to see how this week panned out, because oh, sorry folks, that didn't work. There we go. What screen are you guys on here? I want to go back to here. While we're talking about this, let me just pull it up very quickly. You're like you said, that's why it's options, Sam. You're right. Options give us options, and sometimes they give us too many options. Let's go to big charts here, and I just want to go to 1 month. There we go. Okay, so there's the 33 and a gap down. I mean, that's so ridiculous. Okay, you can see it right there. It's one of those things when a customer calls me up and says, I think the market's out to get me. Every trade I make in the after hours, it moves down, and there's no reason for it to move down. Well, this one felt it. Here was the close on the 8th, or on the 9th. Here's where it opened. It opened immediately at about 33, and I saw it go up to 33.80 after hours, okay, on the 9th. And then it just went down here, and it closed almost exactly where it was the day before. No one could have taken those prices. No one could have gotten closed. Even with a stop order at your broker, you couldn't get filled because it dropped so quickly after it opened up, and it was higher at close of business. And so now it's kind of moved back and gone up a little bit, and it's hanging here. So I want to see what next week brings before I decide to adjust the call or the put, or add the credit spread into the middle of that long strangle, or add the short strangle near term into the middle of the long strangle far term to create the double diagonal, or maybe an inverted collar. Or a condor, excuse me. We'll take a look. All right. Well, ladies and gentlemen, thank you once again for joining me today. Whew. Take a breather, take a break, rest your brains. I'm going to rest mine. You guys have a fantastic weekend. I will see you next week at one of our other webinars and our other presentations. And we'll see you soon. Anytime you have any questions, remember, just send me an email to support@powerop.com or just give me a call during market hours as well. We'll see you guys soon. Good night.